How does the stock market actually work? Let's break it down from the very beginning. Let's start with the basics. What is a stock? A stock is a small piece of ownership in a company. When you buy a stock, you become a part owner of that business. For example, if Apple has 1,000,000 shares and you own one of them, you own 1/1,000,000th of Apple. If the company grows and becomes more valuable, your shares become more valuable too. That's how investors build wealth. But why would a company sell pieces of itself to strangers? Companies need money to grow. They need to hire people, build products, and expand into new markets. They have two main options. They can borrow money from a bank, which means taking on debt and paying interest. Or they can sell shares to investors. This is called raising equity. The company gets cash and investors get ownership. When a company sells its stock to the public for the very first time, it's called an IPO, which stands for Initial Public Offering. So now you know what a stock is, but where do you actually buy and sell them? That's where the stock market comes in. Think of it like a farmer's market, except instead of buying fruits and vegetables, you're buying and selling pieces of companies. The stock market is just a place that connects buyers with sellers. Someone wants to sell their shares, someone else wants to buy, and the market matches them up. In the United States, there are two major stock exchanges. The first is the New York Stock Exchange, also known as the NYSE. It's the largest stock exchange in the entire world. Companies like Coca-Cola, Walmart, and Disney trade here. The second is the NASDAQ, which is known for technology companies. Apple, Google, Amazon, and Microsoft all trade on the NASDAQ. Now you might be wondering, when can you actually trade stocks? The stock market is open Monday through Friday from 9:30 in the morning to 4 in the afternoon Eastern Time. It's closed on weekends and major holidays. But there's also something called pre-market trading, which starts as early as 4 in the morning, and after-hours trading, which goes until 8 at night. Pre-market and after-hours trading have lower volume, which means prices can be more volatile. Most beginners should stick to regular market hours. So how do you actually buy a stock? It's easier than you might think. Step 1. Open a brokerage account. This is like opening a bank account, but for investing. Popular apps include Robinhood, Fidelity, and Charles Schwab. Step 2. Deposit money into your account from your bank. Step 3. Search for a stock using its ticker symbol. For example, Apple's ticker is AAPL. Step 4. Place an order. Choose how many shares you want and hit buy. Congratulations, you now own a piece of that company. But before you place your first order, you should know there are different types of orders. A market order buys the stock immediately at whatever the current price is. It's the fastest way to buy, but you might pay a slightly different price than what you see on screen. A limit order lets you set the maximum price you're willing to pay. The trade only goes through if the stock hits your price. You have more control, but the trade might not happen right away. And a stop-loss order automatically sells your stock if it drops below a certain price. It's a way to protect yourself from big losses. Now here's the big question everyone asks. What makes stock prices go up and down? It all comes down to supply and demand. When more people want to buy a stock than sell it, the price goes up. There's high demand and limited supply. When more people want to sell than buy, the price drops. There's too much supply and not enough demand. When people say the market is up or the market is down, they're usually talking about a market index. An index tracks a group of stocks to give you a snapshot of how the overall market is doing. The S&P 500 tracks 500 of the largest companies in the US. It's the most widely followed index and is often used as a benchmark for the entire market. The Dow Jones Industrial Average tracks 30 major companies. It's one of the oldest and most well-known indices in the world. And the NASDAQ Composite tracks all the stocks listed on the NASDAQ exchange. Because it's tech-heavy, it tends to be more volatile than the other two. But what causes people to want to buy or sell in the first place? Company earnings reports. When a company makes more money than expected, investors get excited and buy more shares. News and current events. A new product launch, a lawsuit, or a CEO stepping down can all move the stock price. Interest rates set by the Federal Reserve. When rates go up, borrowing becomes more expensive and stocks tend to fall. And finally, investor psychology. Fear and greed are powerful forces in the market. Not everyone invests the same way. There are different types of investors. Day traders buy and sell stocks within the same day. They focus on short-term price movements, sometimes holding a stock for just minutes. Swing traders hold stocks for days or weeks, looking for medium-term trends and patterns in the chart. And long-term investors buy and hold for months or even years. They focus on the big picture and let their money grow over time. One of the most popular strategies for long-term investors is called dollar-cost averaging. Instead of trying to time the market and buy at the perfect moment, you invest a fixed amount of money on a regular schedule. For example, $100 every week, no matter what the market is doing. When prices are high, your $100 buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your cost and reduces risk. Dollar cost averaging takes the emotion out of investing. You don't have to worry about whether today is a good day to buy. You just stay consistent. You've probably heard the terms bull market and bear market. Here's what they mean. A bull market is when stock prices are rising over a sustained period. Investors are confident and optimistic. Think of a bull charging upward with its horns. A bear market is the opposite. Prices are falling and investors are fearful. Think of a bear swiping downward with its claws. Historically, bull markets last longer than bear markets. The stock market has always recovered from downturns over time. So how do you actually make money in the stock market? There are two main ways. The first is capital gains. You buy a stock at a low price and sell it at a higher price. The difference is your profit. Buy at 100, sell at 150. You just made $50. The second is dividends. Some companies share a portion of their profits with shareholders. You get paid just for holding the stock, usually every quarter. Now here's something a lot of beginners don't think about. When you make money in the stock market, you have to pay taxes on it. If you sell a stock within 1 year of buying it, your profit is taxed as a short-term capital gain. This is taxed at your regular income tax rate, which can be pretty high. But if you hold the stock for more than 1 year before selling, it's taxed as a long-term capital gain. The tax rate is much lower, usually between 0 and 20%. This is one of the biggest advantages of long-term investing. You pay significantly less in taxes just by being patient. But let's be real, investing is not all sunshine and rainbows. There are real risks involved. Stock prices can drop significantly, sometimes overnight. Individual companies can go bankrupt and become completely worthless. Emotional trading is one of the biggest mistakes beginners make. Buying when prices are high out of excitement and selling when prices drop out of fear. And remember, past performance does not guarantee future results. Just because a stock went up last year doesn't mean it will this year. Let's recap the key takeaways. A stock is a piece of ownership in a company. Stocks are traded on exchanges like the NYSE and NASDAQ. Prices move based on supply and demand. You can make money through capital gains and dividends. All investing carries risk. Start small, learn as you go, and think long term. If this helped you understand the stock market, hit that subscribe button and like the video. New finance videos drop every week. See you in the next one.